Hello friends. Last week in my video, I discussed with you how the market was basically being held up by the average retail trader. And retail traders basically tend to have very limited firepower, they tend to have limited resources on their hands, and therefore it was a very tricky situation for them to keep the market supported very well. In this week's video, in addition to the usual studies, I want to discuss with you why the markets fell. Is the rally basically over for calendar year 2024? Have the markets reached a bottom? And if they haven't reached a bottom, what is the likely support at which you could basically bet that the markets have bottomed out and they could possibly go up again? Now, let's take everything point by point. Basically, like I told you, the retail could not really provide enough by way of aggressive buying support. How did I arrive at that conclusion? Number one, do remember that I told you in this video about MWPL that retail is basically spotted by A, the churn ratio, and B, the ticket size per trade. The ticket sizes per trade, at least for the last couple of weeks, were very, very clear that it was not institutions, it was the retail guys who were buying and pushing the markets higher. If at all the institutional guys, the ultra high net worth UHNI and high net worth individuals, HNIs, if at all they were doing something, they were offloading. So there was distribution taking place there. And I kept on telling you that high MWPL or market wide position limits was a very, very tricky situation, because whenever the market scenario changed, a whole lot more exposure would need to get squared up, and that would lead to a crowded exit. What is a crowded exit? For example, if there's a fire in a building, people rush in a very, very haphazard manner. It leads to a stampede. Even if the fire doesn't kill anyone, the stampede possibly could injure and kill people. That is a crowded exit. And what you saw last week were my fears coming true. And as I've said in these two videos about procyclicality, I was expecting procyclicality in calendar year 2025. I admit procyclicality might have arrived. I'm using the word might. Conclusive evidence has not yet been accumulated, but a fair degree of possibility exists that I have basically been caught off guard, because we were prepping our systems for 2025 and procyclicality may have come 2.5 months earlier. But what do we do from here on? Like I've said in these videos, I even gave you a trading strategy in procyclical markets, so nothing is lost. Now, something that you need to understand as a retail trader. I presume you are a doer of deeds if you're watching my video, rather than a basically guy sitting on the stands and just watching as a passive spectator. So you would have seen how the markets fell on 4th of June, that was election results day, 23rd of July, that was the budget day. Between 2nd and 5th of August, one was a Friday, the other was a Monday, the market fell very sharply. Then between 4th and 6th of September, the markets fell sharply again, finally to peak out on 27th of September. It's very easy for a non-market participant to be extremely bullish, to be extremely gung-ho and say, look, think of the long term. Just remember what Warren Buffett said, if the market shuts down for 5 years, don't panic. That's all right for long-term investors, value buyers. But you and me, I presume, are traders. I know about myself, I'm a trader, not an investor. So what does a trader do? He gets butchered with the kind of declines that he saw in June, July, August, and September. It's all right to say hold on, but when the price falls 10, 15, 20%, mark-to-market losses become this big, your brokers cut off your trade by not even intervening manually. The risk systems in their back office software simply eliminates your trade because of want of margin money. So that way, the buying power of the average retail trader was broken from 6th of June onwards. In my video of a fortnight ago, I pointed out to you how traded volumes, both in stock futures and in the spot market, were the lowest in 2 quarters. That's a bad sign. If at all markets are hitting new highs, which they were, the Nifty touching 26,277 odd points, you need more and more buying to keep the momentum, to keep the tempo intact, whereas buying was hitting multi-month lows. That was a red flag, and I remember using the word red flag as such. FIIs were selling non-stop throughout the month, and in spite of robust foreign exchange reserves which were hitting lifetime highs above $700 billion, the rupee was hitting new lows against a strong dollar index. That basically exerted pressure, and the bond yields refused to go down any further. I told you, I distinctly remember telling you 6.50 to 6.75, maybe 6.80 is the band where Indian 10-year benchmark bond yields will get support. I kept on cajoling, pleading with my online family, please understand the concept of cost of money. If you do not understand the cost of money, you will come to grief. I gave you recommendations of Dick Stoken's work, who, for traders like me who cut their teeth in the market in the 1980s, was a super god where cost of money is concerned. His books written in 1990s are still highly recommended. Which ones to buy? Somebody asked me. Buy all of them. You'll die a rich trader if you read any and everything that is relevant, accurate, credible about cost of money. The bond convexity metrics, if you had put in your statistical trading model, would have told you that a fall is coming, because cost of money going up pushes riskier assets down. In these two videos on options trading, which I put up a couple of months ago, I very distinctly told you that an option writer has an unfair and a huge advantage over an option buyer. Why? Because an option buyer is paying interest, the option seller is receiving interest. That is a big difference. Now imagine the market fell in June, July, August, September, and now of course in October. If a guy who is going long and listening to the Parma bulls who are sitting on the sidelines and giving advice to be brave, kept on rolling his long positions month after month for 5 months, assuming all in all, cost of carry, brokerage, execution costs, taxes, GST, etc., and the usual cost of carry, the difference between current month and next month futures, paid on an average of $100 on the Nifty as rollover. It's a hypothetical figure, let not split hair. Your cost is gone up by 500 rupees on the Nifty just because of sheer cost of carry alone. You have paid interest. Who made the money? The guy who short sold, because he received the cost of carry. So the cost of fund theory, had you known, you would have known that a tired bull got tired not just because the price was not rising or even falling, but because he was tired by a twin impact of falling prices and paying interest costs on his long positions. Now, for the crux of the matter, I'm sure you'll all want to know whether the selling is done and over. I don't think the selling is done and over. There might be an intermittent or even an intermediate rally, a relief rally, call it a dead cat bounce, relief rally, technical pullback, whatever you will. Let's not forget this is an expiry week up ahead, and ahead of expiry, some amount of shorts do tend to get squared up because more of longs get carried over as compared to shorts. So short coverage can basically trigger off a near-term pullback rally, and it could be a fairly vicious one. But do remember that a short covering base rallies, even though vicious, do tend to be temporary in nature. So let's be careful out there. So should you short at this present moment? It's very highly risky unless you're very, very risk experienced and risk savvy. I don't think you should be rushing at these levels because the low hanging fruit in terms of short sales are already over. Now, is the selling over? I don't think so. MWPL is at 45%. We will cover MWPL when we come to our in-house indicators. I still see a lot of hope. I do not see signs of fear yet. Your market will stop falling when absolute fear comes in, because the retail guy tends to buy late. He is a Johnny come lately. He will also sell late. Just when he should be buying, he'll start selling in a panic. So that panic is not yet come. So I don't think a bottom has been formed. Has a top been formed for 2024? I think there is a greater probability of a top being formed in 2024, not a bottom being formed in 2024 and what remains of the year. We'll come to the technical analysis of the indices and see that then. So friends, let's dive right into a regular feature. Coming up on your screen is the weekly market roundup window, and that tells you that it was a broader based Nifty 50 which led the decline. Brought up very close behind was the Bank Nifty. Do remember, the banking space commands a weightage of 32.5% in the Nifty itself. And the US dollar index continued to surge higher. It crossed 104 levels and stayed above that, which pressurized emerging markets, including India. Now, in spite of the fact that the US dollar is up and it's an invoicing currency for commodities, gold and silver went up. Hey, what does that tell you? That tells you that defensive buying was seen. Safe haven buying was seen. Natural gas went up. It's deceptive to say it has gone up. It's nothing but the cost of carry in the winter months. Do remember, I've told you many a times, it is a novice or a newbie who makes the grave error of thinking that natural gas is in a super cycle at this time of the year. This is nothing but heating demand coming in winter. Crude oil went up due to geopolitical reasons as the Israelis launched retaliatory strikes on Iran. The USD INR, the United States dollar versus the Indian rupee, rose marginally, which means the rupee basically weakened a little bit. The Indian 10-year benchmark bond yields rose 4 basis points. That means Indian bond prices fell marginally, and that exerted somewhat of an increased pressure on the Bank Nifty. The NSE market capitalization fell a whopping 4.61%. Now that I have told you 2 years ago, whenever the NSE market capitalization falls by more than 3 to 4% in a week consecutively for 3 weeks in a row, a big decline has ensued. So count this as week number 1. For 2 more weeks, if the declines exceed 3% in market cap, a bigger fall is in the offing. The market-wide position limits hit 45%, although intra-week it was higher, but on Friday it closed at 45%. This is the highest in many quarters. The US market saw the Dow Jones and the S&P 500 decline somewhat, and the Nasdaq just about gained a tad and provided tailwinds to our markets. Now friends, I come to the ratio chart. The Bank Nifty versus the Nifty 50 attempted a rally but failed. It was an abortive rally, and therefore the bulls would have to wait somewhat longer. Now friends, why do I say that the Bank Nifty versus the Nifty ratio chart matters? Just take a look at the weightages. If you take the banking and financial sector stocks, they are quite simply the heaviest weighted sector. Without this sector rallying, you cannot have a big rally. Which is why, in spite of poor results, in spite of the poor sentiments, in spite of the RBI governor giving warnings about evergreening of loans, reckless lending where personal loans are concerned, credit cards are concerned, MSME exposure is concerned, the banking space was not falling where stock prices are concerned. Because the big hands were pushing up banking stocks, knowing fully well that 32.5% weightage would pull up the market overall. Friends, I now come to our in-house indicators, starting with the MWPL, which hit 45%. As you can see, it's a multi-month high. Now, this is a problem. Like I said in this video, a dedicated video on MWPL, unfortunately, for some reason known to them, I don't see anybody else talking about this wonderful study. This is A greed and fear gauge, B, a doer of deed gauge, and see a warning sign in advance. Now, in that video, like I said, MWPL hitting a level of 45 is an indicator of very high degree of greed. I would say the highest degree of greed. I would call it a red light, not even a red flag. It's a blazing red light. Why? Because if something was to go south, fall, negative, 45% exposure has been utilized by traders compared to what SEBI allows. These huge positions would have to be unwound. Can you imagine the price volatility that could occur when these big positions could get unwound? That is what I fear whenever I see MWPL go up. Which is why I told you, if you want to target stocks before the budget, before the election results, I gave you the highest MWPL gainers and losers for a week in a row on my Telegram channel, which is because the highest action was in these counters. Crowded entries, crowded exits happen with high MWPL. If you're a lion, you want to hunt the weakest deer. The highest MWPL counters are your weakest deer. Now, friends, I come to the turnover. This is 3 concurrent series. That is October, November, and December. Turnover was higher. Not a surprise, because expiry is around the corner and people are squaring up their positions in the October month and reinitiating the same in November. So dual turnover is resulted and turnover goes up. Now, NSE advanced decline ratio is speaking a very, very nervous story. The Nifty has basically fallen 2.71%, and the advanced decline ratio has fallen from 0.82 in the prior month to 0.49. That means for every 100 losing stocks, there were only 49 gaining stocks last week. This speaks very poorly of one marshmallow or intraday traders buying conviction. They don't seem to be buying aggressively. The marshmallow theory is in the pinned comment and the description below. Do watch that tutorial video. Now, friends, I come to the basis of the Nifty and the Bank Nifty. Basis is nothing but the discount and premium prevalent in the futures compared to spot. The basis has very simply shrunk. I could have even said fallen, but merciful God, it's still in positive. So what happened was that all the fluff, all the optimism, all the greed basically just came out like a balloon loses its air. Now, as long as the basis is positive, which means it does not invert or go into minus, bulls still have a chance. But if you start seeing Nifty and Bank Nifty in the October series trade in the negative in the coming week, you know that aggressive short selling is occurring. That would be a strict no-no. Now, friends, I come to our in-house indicator, the impetus. You've enjoyed it for almost 4 years in a row now, and it's lived up to its expectations. Impetus measures the momentum in any move, and last week what you're seeing is impetus jumps very, very smartly in the Nifty. And remember, the Nifty fell more than the Bank Nifty. Even though the Bank Nifty fell, the impetus didn't rise as much as the Nifty's, but what I can surmise is that the fall was on very strong momentum. There was aggressive short selling and selling, bull unwinding. Relatively speaking, the selling was more in the Nifty, and that's worrisome because Nifty is the broader index of the two. Now, friends, I come to our exclusive in-house indicator, the LWTD, which I'm proud to say is a very, very accurate and leading indicator. I update the impetus, the LWTD, etc. on our daily social media accounts. Do connect with us. Contact coordinates come at the fag end of this video and below in the description and pinned comment below. So the LWTD has fallen to -6.2 as compared to the prior week's -2.0. The Nifty has also fallen. What does it tell you? It tells you that fresh buying support will be extremely feeble, if at all. At most, you can expect short covering to temporarily boost the market. I'm not really surprised. Do remember, it's an expiry week, so people normally would be focused more on rolling over their positions rather than creating fresh ones. The LWTD is giving you another warning sign. I now come to the bond market, which is very close to my heart. And as you can see on the weekly chart of the Indian 10-year benchmark bond yield, the bond yield seems to have struggled, but managed to basically inch higher. That tells you that bond prices were marginally lower. Now, unless and until I see bond yields above the 7.2, 7.3%, I'm not going to go out there and venture any more fresh exposure in the 10-year sovereign paper. As if you have been with me after at least October 2021, you would have laddered the yields all the way up to 7.6, 7.7. We are sitting pretty. And then if the bond yield was to collapse below the 6.4, then maybe, just maybe, I might take a relook at the opportunity of re-entering gilt funds which we exited in March at a good profit. But so far, we are in no man's land. I'm not keeping any kind of fresh exposure on my mind in the coming week at least. If I do, the first place you'll hear from me is on my Telegram channel, followed by the WhatsApp channel. Contact coordinates below this video. Friends, the bond market's done. I now come to the Bank Nifty, and as you can see on the daily chart on your screen, the Bank Nifty fell on 4 out of 5 trading sessions. The price is below its monthly moving average, which itself is turning downwards. We are nearing the low made on 7th of October, which was at 50,194 levels. The head and shoulder on the daily chart of the Bank Nifty is not yet confirmed because the price needs to close below the neckline of the head and shoulder by at least 2% for 1 or 2 trading sessions. It's not yet there. We'll need to see if the neckline holds in the week ahead. The weekly chart on your screen shows a bearish engulfing pattern. Now that is a sign of concern for the bulls. And the breach of the 25-week exponential moving average, which is a 6-month long holding on cost of an average investor. So the medium-term outlook is nervous for now. The bullish wedge, those two trend lines which are converging, the bullish wedge pattern, the lower trend line of that pattern may offer support at approximately 49,500 levels on the Bank Nifty. And do remember, the banking and financial sector space commands a sectoral weightage of 32.5% in the Nifty. So without the Bank Nifty rising, there cannot be a confirmed bull market in the market at all. I would feel bullishness has returned to the market only after the Bank Nifty spot trades consistently above the 52,600 levels. Friends, in the week before last, this index was number 7 on the most volatile counters list that I maintain in-house based on statistical beta rankings. It fell by 1 notch to number 8. Why is that, in spite of all that volatility? Because the relative volatility of individual stock counters jumped up. It was pretty high. So the Bank Nifty appears to have fallen in the rankings, but make no mistakes, it's extremely volatile. Be very, very careful out there. Now, last week, I advocated an estimated range between 53,575 on the upside and 50,600 on the downside. It fell below the estimated support and it reached 50,382. Which is 218 points below my anticipated support. In the coming week, I estimate a range between 52,325 on the upside and 49,250 on the downside. It seems to be extremely wide, but believe me, the intraday ranges are likely to be wide and the range may be even exceeded in either one of the directions. Friends, in addition to all these ranges, please do monitor our daily, weekly and monthly pivots, which we provide for free on our Telegram and WhatsApp channels. And these basically the pivot levels are explained in this video as to how you can make use of them for entry and exit, intraday, swing trade, and for the buy and hold trader. Friends, I now come to the Nifty 50, which fell 2.71%. As you can see on the daily chart on your screen, the index fell on all 5 of the 5 traded sessions last week. And what you are seeing is the head and shoulder pattern on the Nifty having been established and activated. The price after falling on all 5 trading sessions last week, has fallen below its monthly moving average, which itself is trading downwards. So the short-term trend is nervous. The established head and shoulder pattern has a target of 23,250 odd levels, and that basically will see a marginal possibility of some support emerging. I'm not saying that it needs to come, 23,250 needs to come in this week itself. Maybe there could be a pullback due to short covering on expiry related considerations, and as long as the price doesn't go above the swing, the neckline, I think the swing is just a pullback rally. The weekly chart on your screen shows a bearish power candle which has pierced the 25-week exponential moving average. It is the 4th weekly fall in a row. Now, since this 25-week exponential moving average is a 6-month long holding on cost of an average bull, the medium-term outlook has also turned nervous as of now. These sentiments can reverse if the 25,200 level is overcome by the bulls. It's a good round number, and short covering might just take it there. But as of now, it's a sell on rallies. Volumes may be marginally higher this week, not because of trader participation, but due to rollover. Traders are basically squaring up their positions in October and initiating them in the next month in November. Bid and offer spreads may be wider. That means your take-home profits, even on those trades where you are right, might just be smaller. So it's time to be careful out there. Trade light, keep a smaller footprint. Like I mentioned in this video, trading light with bigger price objectives and targets makes more sense in extremely volatile markets. Also, keep hacienda hedges, as I've mentioned in this video. These are lifesavers in times of extreme volatility, the kind of which you saw last week. In the week before last, this index was number 27 on our most volatile counters list as per statistical beta rankings in-house. It climbed 16 notches to number 11. Now that tells you that the challenge level for retail traders has gone up significantly. Last week, I estimated a range between 25,475 on the upside and 24,250 on the downside. The low was again breached marginally because the low was 24,074. In the coming week, we estimate a range between 24,825 on the upside and 23,550 on the downside. Ranges can expand due to sheer volatility. Be cautious, trade light. And in addition to these ranges, please do watch the daily, weekly, and monthly pivots that we basically put up on our free Telegram and WhatsApp channels. Friends, the indices done. I now come to the last bit of statistical analysis in which I gauge the retail risk appetite by their footprint in the 4 segments in the derivative space. Now, index futures rose, their turnover contribution rose by 11 basis points, indicated as a red line. Stock futures turnover rose by 12 basis points, indicated as a blue line. This is primarily because of expiry. You're seeing squaring up in October and initiating of the same trade in November. Index options, the lowest of them all in terms of risk and margin requirement, saw lower turnover contribution by 63 basis points, indicated as a green line. Stock options turnover went up by 49 basis points, indicated as a purple line. So turnover was higher due to expiry, but since in expiry, higher turnover means bigger rollover, that itself tells you that the risk appetite still remains robust. There is still greed in the market, which is what I told you. Capitulation or surrender has not yet come, which is why a bottom is not yet in place. You might see a rally ahead of the expiry, but a firm bottom is not yet here. Friends, now I come to my strategy for the trading week ahead. It will remain largely unchanged. Small exposure, big price moves as per that video which I told you. And tail risk hedges remain an evergreen strategy as far as I'm concerned. My focus will remain on PSU stocks. I've explained to you in this video why I prefer PSU stocks which provide me good trading opportunities. Within the PSU space, I will focus on public sector banks, oil marketing companies, energy, power, defense, and logistic companies. Metal prices came down instead of rising on the exchanges last week, which is what usually happens ahead of the month end. And that short covering would have basically seen prices of metal mining stocks go up, but that did not happen. So metal mining stocks might just remain higher than usually volatile. And if you're savvy with taking risks with big price moves, this is another sector you can watch out for. Oil and gas are likely to be news driven and also impacted by the cyclicality. Do remember, gas is used as a default fuel for heating indoors during the winter, and oil is basically driven by geopolitics. But the overall view is unchanged. The long-term outlook is down. So therefore, theta decay strategy remains in place continuously. Now, bullion long-term story remains intact, but in the short term, do remember what I told you in this bullion video, which I made very, very recently. If at all there is a big amount of unwinding of long positions in the stock market because of mark-to-market pressures, there is no recourse to an average trader but to sell everything, unwinding bullion included. So don't think that just because silver has tested 1 lakh rupees and gold is coming within a kissing distance of 80,000 rupees, sell every stock at a loss and get down into buying bullion. That would be too aggressive and too reckless. It doesn't really quite work that way. So unless you're fixated about taking delivery and sitting there for many, many quarters, if not years, bullion may just encounter some amount of declines, as I mentioned in that video. But like I said, sure, I'm a long-term bull even at present levels. Friends, in case I need to share any more ideas with my online family, the default place would be my Telegram channel, followed by my WhatsApp channel also. I thank you for your patience in being with me in this video. Don't go away without subscribing to this channel. Click on the bell icon to receive instant alerts about fresh videos being put up out here. In the comment segment, do let me know how my videos are helping you and what more you would want me to record for you to become a better trader. And a request, please share my videos with all your friends, family, and social media groups to help me reach out to a wider audience. I thank you for your patience. I wish you have a very, very profitable week ahead. A very happy Diwali in advance. Take care. Bye-bye.